very good morning to all. Myself Ani Sultana, working as assistant professor, belongs to Department of Management Studies, SNS College of Technology. Today we are going to discuss a topic that is payoff options in unit number 4 valuation under the subject derivatives and risk management. So let us have a quick recap on the previous session, and we were discussing on the various differences between the futures contract and options contract. So let us now point out what are the specifications on which the futures and options contract will vary. First one, here we have obligation to buy or sell. Here in futures contract we have the obligation, but whereas in the options contract we have the right but not the obligation. And next we have no upfront premium. So with regard to the our futures contract, we don't have any premium to exercise the contract, but whereas in the options contract we have the premium paid out option. Unlimited profit and loss. So here when we compare the futures contract, we have the unlimited, which means there is no estimated profit or loss. We either the investor may experience the highest profit or at the end lowest profit. Limited loss for the buyers. Here as we discussed in the second point, there is an option for premium. So here we are expecting only the limited losses. In case if we are facing any loss situation, we will expect only limited losses. Here the trading functions on the daily market basis. Here the trading executed on the flexible strategies. Say for example, if the BSE stock exchange faces a little suppose if I buy for a 10 rupees in option contract, suppose the next day or even if in the evening I am facing a 1 rupee profit, my call option can converted as a put option. We know that call option means we have the right to buy, put option means have the right to sell. Sorry. So when we discuss on these strategies, immediately if I am facing a profit, I can able to give out my option. So now we are going to discuss on the positions, various positions in the options contract. That is the valuation of the options contract. We have long position, short position, and we are going to discuss on the risk management and as well as the strike prices. So long positions means we are holding the options, our stock we are holding based on the holding capacity of the stock. Here long position means betting on the price movements with limited downside. Here short position means profiting from the price declines with premium income. This is called the long and short position. Risk management, we know that hedging strategy, how the hedging strategies can be performed using the futures contract. And we have the strike prices options. What we know that strike prices means we are executing the contract on the what is the strike price that we have already fixed. So now before getting into the topic, it is necessary to understand the basic fundamentals of payoff of options. First we have to understand of the future settlement price. Here future settlement price is denoted by the notation F, the final price of the futures contract at expiration. So for example, if we are entering into a 3 months contract where the contract is being exercised at the time of maturity after 3 months. So what is the price that we are going to execute the contract? Say for example, today we have a price of rupees 15 rupees. We are executing the contract for rupees 20 rupees at 3 months expiration date, which means our strike price is rupees 20. That is the future settlement price. Strike price is denoted by the notation it is K, the predetermined price at which the options can be exercised. So based on the current price, we are fixing the future price. So this is the difference between the settlement price and the strike price. Strike price means which is the price which is prevailing in the future. Settlement price means the price at which we are going to make a settle down. For example, if we take premium. So if we do not consider premium, only with the strike price we are going to settle executing the contract means it means the future settlement price. Suppose if we are adding any premium, so we call it as strike price. So premium, we know that it is the upfront cost paid by the buyer to the seller. Here we have the long call option on futures. So here the formula for the long call option futures is the payoff option formula, that is maximum of 0, f minus k minus premium. We know f is the price at which we are going to settle the options, and k is the strike price, and premium we know that the price at which the here we have discussed, that is the upfront cost paid by the buyer to the seller. Okay. So what are the key characteristics we have here to have? We have to follow is, one is the bullish strategy, and we know that what is the we have two positions, that is bear and bull. So what kind of strategies can be adopted while executing the long call option? Here we have the right to buy the futures. Here the contract can be exercised when the settlement price, that is F, is greater than strike price. So here the risk is defined its position. So here what is the situation we will expect is, so potential profit, because unlimited upside as the settlement prices increases. So here when the settlement price increases, we can expect the unlimited upside position. Here in case of premium, if you take premium, it is the limited to premium we have paid, which means we are incurring the maximum loss. Next we have short call options on futures. Let us discuss this topic in the next class. Thank you for listening the video.